Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Invesco is a global asset manager founded in Atlanta in 1935. Today, it manages roughly $1.8 trillion across equity, fixed income, and alternatives platforms worldwide.
The defining product is QQQ, the Invesco QQ Trust tracking the NASDAQ 100. With over $300 billion in assets, it ranks among the most actively traded securities globally.
QQQ generates stable fees in any market environment. In volatile periods, traders use it daily to gain or hedge NASDAQ exposure, making it structurally vital to the global ETF ecosystem.
Beyond QQQ, Invesco built a significant factor and smart beta ETF lineup. Low volatility, equal weight, and momentum products provide shelf space that purely passive index providers cannot replicate.
The firm grew through acquisition. The 2018 Oppenheimer Funds deal added over $240 billion in AUM, and the 2010 Van Kampen purchase deepened the fixed income platform substantially.
CEO Andrew Schlossberg took over in 2023 after leading the Americas business. He inherited a firm navigating active management fee compression and accelerating flows toward lower-cost passive strategies.
The effective fee rate sits around 28 basis points across the AUM base, higher than pure passive shops because Invesco still earns elevated fees on active and alternatives mandates.
The alternatives platform covering real estate, private credit, and infrastructure is a strategic priority, providing higher margin AUM that passive providers cannot compete away simply through pricing.
Invesco sits between passive giants like BlackRock and Vanguard on one side and active boutiques on the other, a competitive middle ground requiring real product differentiation to profitably defend.
That differentiation comes from QQQ market structure importance, the factor ETF lineup, and growing alternatives, three revenue streams a purely passive competitor cannot easily commoditize.
Invesco sits between passive giants like BlackRock and Vanguard on one side and active boutiques on the other, a competitive middle ground requiring genuine product differentiation to defend.
That differentiation comes from QQQ market structure importance, the factor ETF lineup, and growing alternatives, three revenue streams a purely passive competitor cannot easily commoditize.
Organic AUM growth of 2 to 3% per year is the baseline. Anything beyond that, from market share gains or new products, would represent upside versus current investor consensus expectations.
The bear case is secular. Sustained outflows from high-fee active strategies and ETF fee compression could gradually erode economics even of a strong franchise like QQQ over the long term.
The bull case rests on QQQ permanence, alternatives platform growth, and a stock that already reflects many secular concerns at a discount to larger diversified asset management peers.
The core question is whether QQQ franchise value and the alternatives build-out can offset secular active outflows, a tension that will define Invesco's financial trajectory for years ahead.
That's the company chapter for Invesco. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
What if one of the most powerful revenue streams in the entire asset management industry came not from managing money, but from simply licensing a name? Invesco collects a royalty fee on every dollar sitting in QQQ, the world's second largest ETF, with over $330 billion in assets. Invesco does not manage those assets. It holds the licensing rights from NASDAQ and collects a fee on the total fund size, essentially a toll booth on the NASDAQ 100 index. That near-zero-cost revenue stream funds a global asset manager with $1.6 trillion of assets under management across equity, fixed income, and alternatives. Today we are digging into Invesco's first quarter 2026 results, the QQQ engine, the alternatives build-out underway, and whether this stock trading near book value is a genuine value opportunity or a classic value trap. I am Hudson, joined as always by Lana. Let us get into it.
Thanks, Hudson. Invesco is a global investment management firm headquartered in Atlanta, Georgia, with offices across more than 20 countries and a client base spanning retail, institutional, and sovereign investors. The firm manages equity, fixed income, multi-asset, and alternative strategies, but its most distinctive and valuable asset is the QQQ franchise. Invesco does not run QQQ. The Invesco QQQ Trust passively tracks the NASDAQ 100 index, but Invesco holds the licensing rights from NASDAQ and collects a management fee on every dollar in the fund. With QQQ at $330 billion and growing, that fee stream is substantial and comes at near zero marginal cost. Beyond QQ, Invesco has been building its alternatives business through real estate, private credit, and bank loans, while expanding its factor and bullet shares ETF lineup. The firm reached its current scale through acquisitions including Oppenheimer Funds in 2019 and MassMutual's asset management business, transforming it into a top 10 global manager by AUM.
First quarter 2026 earnings came in at 57 cents per share, against a consensus estimate of 58 cents, a narrow 1 cent miss. Revenue landed at $1.27 billion. That slight shortfall was driven by a combination of continued fee rate pressure on active strategies and modestly elevated operating expenses tied to technology investment and distribution costs. Assets under management held up well at over $1.6 trillion, supported by continued ETF inflows. Organic net flows were slightly positive across the ETF book, even as active equity strategies saw modest outflows, a pattern the entire active management industry has faced for years. Management maintained full-year guidance and highlighted improving momentum in alternatives and fixed income. The miss was narrow, and the underlying flow picture was not alarming, but active fee pressure remains a structural conversation that investors revisit every quarter when Invesco reports.
On the income statement, Invesco's revenue of $1.27 billion reflects investment management fees as the dominant line, supplemented by performance fees and service and distribution fees. Operating expenses remain elevated because Invesco carries the cost structure of a firm that grew through acquisitions. Compensation, technology, and amortization of intangibles from the Oppenheimer Funds deal all weigh on margins. Adjusted operating margin runs in the low to mid-30% range, which is respectable for a firm of this complexity, but trails the leanest passive-only managers. Net income attributable to common shareholders came in consistent with the per-share figure after accounting for the diluted share count. One important nuance: a meaningful portion of Invesco's revenue is tied to average AUM for the quarter, meaning market-level moves in the prior quarter flow through to reported revenue with a lag, making AUM trends the most important forward indicator to watch.
Invesco's competitive moat is unusual in asset management. The QQQ licensing arrangement is effectively irreplaceable. Invesco holds those rights, and there is no practical path for a competitor to replicate that franchise. That creates a recurring high-margin revenue stream that behaves more like a toll booth than active fund management. Beyond QQQ, Invesco has built meaningful scale in bullet shares defined maturity bond ETFs, a category it essentially pioneered, giving financial advisors a tool to build bond ladders with ETF convenience. In alternatives, the firm has real estate debt and equity capabilities, private credit, and bank loan strategies that attract institutional capital seeking less correlated returns. These alternative strategies carry higher fee rates than plain vanilla active equity, which helps offset the secular fee compression happening in traditional active strategies. Distribution scale, particularly in the intermediary and registered investment advisor channels, is also a genuine, hard-to-replicate competitive advantage for Invesco.
Cash flow at Invesco is solid and well supports the dividend. The firm generates free cash flow in excess of its dividend obligation, and the payout currently yields over 3.5% at the current stock price of around $16. Invesco has maintained its dividend even through periods of significant AUM pressure, signaling board confidence in the durability of a QQQ-driven cash generation. Capital allocation has leaned toward debt reduction following the Oppenheimer Funds acquisition, which added meaningful leverage to the balance sheet. The firm has made steady progress paying down that debt, but leverage remains a topic investors monitor closely relative to peers with cleaner balance sheets. Working capital is manageable given the fee-based nature of the business. There is very little inventory or receivables risk in asset management. Cash conversion from net income to free cash flow is generally strong because capital expenditure requirements are modest relative to earnings, keeping the cash profile attractive.
On capital returns, Invesco prioritizes its dividend, which at a 3.5% plus yield is among the more attractive in the asset management sector. Share buybacks have been limited compared to peers, largely because the balance sheet still carries the debt load from the Oppenheimer Fund's deal. Management has signaled clearly that as leverage normalizes over time, buybacks could become a larger and more consistent part of the capital return story. For now, the dividend is the primary mechanism. The payout is well covered by free cash flow, and management has been disciplined in protecting it even through challenging market environments. Long-term shareholders who collected the dividend through the past several years of flat to declining share price have still generated a reasonable total return from income alone. But the stock has been a frustrating hold for growth-oriented investors who expected faster earnings expansion following the major acquisitions. The buyback optionality is real if management follows through on debt reduction.
Looking ahead, several catalysts could re-rate Invesco higher from current levels. First, continued equity market appreciation drives QQQ AUM growth automatically. Every 10% rally in the NASDAQ 100 adds roughly $33 billion to QQQ at current size, mechanically increasing licensing revenue at near zero cost. Second, the alternatives build-out is gaining traction with institutional investors increasing private markets allocations. Invesco's private credit, real estate, and bank loan capabilities position it to capture higher fee mandates that were harder to access a decade ago. Third, the Bullet Shares and Factor ETF lineup is growing market share in the registered investment advisor channel, expanding the ETF franchise beyond QQQ. Fourth, if debt paydown accelerates and balance sheet leverage normalizes, management could reinstate more aggressive buybacks, which would be highly accretive at current prices. Each of these is a discrete, trackable catalyst rather than a vague, macro-dependent hope.
Analyst sentiment on Invesco currently sits at a consensus hold, with a price target of roughly $17 against the current price of about $16. That narrow implied upside reflects the market's view that the stock is fairly valued at current levels but not deeply cheap. Bulls point to the QQQ moat and the dividend yield as a floor for total return. Bears worry about the value trap narrative. The stock has traded in a similar range for years without a meaningful re-rating catalyst materializing at scale. Some analysts note the market is not fully crediting the alternative's growth because it remains a small slice of total AUM today. A few shops have upgraded on valuation grounds, arguing that book value support limits meaningful downside from here. The consensus does not reflect strong conviction in either direction, which itself is a telling signal about the risk-reward asymmetry the street currently sees in Invesco shares.
On valuation, Invesco trades at roughly book value, which is historically a floor for asset managers with durable franchises. Price to earnings is in the low to mid-teens on a trailing basis, representing a meaningful discount versus peers like T. Rowe Price or Franklin Templeton. The discount reflects two specific concerns: the overhang of acquisition-era debt and the secular pressure on active management fees. However, if you isolate the QQQ licensing revenue as a separate, effectively cost-free stream, given its near-zero marginal cost, the underlying active and alternatives business appears even cheaper on a standalone basis. Enterprise value to EBITDA is similarly compressed relative to history. The dividend yield of over 3.5% provides a meaningful income floor while investors wait for a re-rating catalyst to emerge. At $16, you are not paying for growth. You are paying for a durable cash-generating franchise and betting the market eventually assigns it more appropriate credit.
Bull case number one. The QQQ licensing engine is a compounding machine that requires nothing from Invesco to grow. As the NASDAQ 100 appreciates over time, reflecting the largest technology and growth companies on Earth, QQQ AUM grows automatically, and Invesco's royalty revenue scales with it. This requires no additional headcount, no new product launches, no marketing spend, and no client servicing. It is as close to a perpetual royalty annuity as the asset management industry offers. If the Nasdaq 100 continues its long-run trajectory, QQQ could reach $500 billion or beyond within a few years, and every incremental dollar of AUM generates licensing revenue that falls almost entirely to Invesco's bottom line. Combined with a 3.5% dividend yield paid while investors wait, the patience case for owning Invesco at book value is straightforward for investors with a genuine multi-year time horizon.
Bull case number 2. The alternatives ramp is underappreciated by the market and not reflected in the current valuation. Invesco has quietly built a credible alternatives platform spanning real estate debt and equity, private credit, and bank loan strategies. As institutional allocators, pension funds, endowments, insurance companies, sovereign wealth funds continue rotating into private markets, Invesco is positioned to capture mandates it could not have competed for a decade ago. Alternative strategies carry fee rates 2 to 3 times higher than traditional active equity, meaning a relatively modest shift in AUM mix can have an outsized positive impact on total revenue per dollar managed. If alternatives AUM reaches 10 to 15% of Invesco's total book over the next several years, from a lower share today, the blended fee rate improves meaningfully before any improvement in traditional active flows. The market is not yet pricing this mix shift in Invesco's current valuation.
Bull case number 3. Debt paydown unlocks significant capital return potential that is not visible in today's financials. Invesco has been methodically reducing the leverage taken on during the Oppenheimer funds and MassMutual acquisitions over the past several years. As that debt normalizes toward peer levels, the firm will have growing incremental free cash flow to allocate, and at $16 per share, buybacks would be highly accretive to per-share value. A reactivated buyback program combined with the existing dividend would meaningfully increase total capital return to shareholders. This is a self-reinforcing cycle. Lower debt reduces interest expense, which lifts earnings, which supports a higher buyback pace, which reduces the share count, which grows earnings per share further. If Invesco executes on debt reduction over the next 2 to 3 years, the earnings power per share could look materially stronger than today, and the stock could re-rate accordingly as the balance sheet clears.
Bear case number 1. Active fee compression is a secular trend, not a cyclical one, and it is not slowing. The asset management industry has been losing ground to low-cost passive strategies for over a decade, and there is no credible sign that dynamic reverses. Invesco's active equity and active fixed income strategies face consistent price pressure from direct competition and ongoing fee renegotiation by large institutional clients who increasingly have the leverage to demand lower rates. Even if Invesco holds its active AUM flat by volume, the revenue per dollar managed is likely to drift lower each year as contracts reprice. This structurally limits earnings growth from the traditional active book, placing an ever heavier burden on QQQ licensing and alternatives to offset the secular headwind. For investors who need a top-line growth story to get excited, the active fee compression narrative is a persistent ceiling that the market has not yet found a reason to look past.
Bear case number 2. QQQ concentration and flow reversal risk are two sides of the same double-edged sword. While QQQ is unquestionably a strength, it also represents roughly 25% of Invesco's total AUM, creating meaningful single-franchise concentration risk. If the Nasdaq 100 enters a prolonged drawdown, as it did in 2022, falling over 30%, QQQ AUM shrinks directly, and Invesco's licensing revenue falls with it. In a severe dislocation, net outflows from QQQ can amplify the AUM decline as investors rebalance or de-risk. The franchise that is Invesco's greatest asset becomes its greatest vulnerability in a sustained risk-off environment. Meanwhile, the acquisition-era debt means the firm has less balance sheet flexibility to absorb a revenue shock than peers with cleaner capital structures. The combination of QQQ concentration and financial leverage is precisely the scenario that keeps risk-conscious institutional investors on the sidelines despite the low valuation.
Bottom line on Invesco. This is a franchise trading at a value investor's price, anchored by one of the most distinctive royalty streams in asset management, a growing alternatives platform, and a dividend yield above 3.5%. The QQQ licensing engine is durable, requires no capital to grow, and scales automatically with equity markets over time. The debt overhang is real but shrinking, and the re-rating catalyst, accelerated buybacks and alternatives AUM growth, is credible if management executes. The risk is the value trap. Invesco has traded in this range before without a decisive breakout. At $16 with a $17 consensus target, the near-term price upside is modest unless the alternatives story or a QQQ AUM surge materially shifts the earnings trajectory. For income-oriented investors with patience, the risk-reward is reasonable. For growth-focused investors, the secular active headwinds make this a show-me story until buybacks accelerate. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.